The ultimate short squeeze filter, identifying under the radar plays before they pop. Most traders discover short squeezes after the move has already happened, when volatility is extreme, risk is asymmetric, and exits become crowded. This framework is designed to flip that dynamic, finding squeeze candidates early, before mainstream attention, social hype, and headline driven FOMO distort price action. This isn't about chasing meme stocks. It's about systematically identifying structural pressure building beneath the surface. Beyond the hype, uncovering the true short squeeze potential. Why most short squeeze gurus miss the mark? The majority of retail focused content revolves around headline metrics, high short interest percentages, viral Reddit posts, or sudden price spikes. By the time these signals appear, shorts have often already adjusted, hedged, or begun covering. Common traps include confusing high short interest with imminent short squeeze risk, chasing stocks already up 100% on social momentum, ignoring liquidity, float structure, and institutional positioning. Real squeezes are quiet before they're violent. The unseen whale indicator. Institutional accumulation often starts well before any visible retail excitement. This shows up not as explosive moves, but as persistent bid support during market weakness, price refusing to break down despite bearish news, gradual volume expansion without volatility. These unseen whales build positions patiently, absorbing supply while shorts grow complacent. Avoiding the FOMO cycle. The edge comes from anticipation, not reaction. By focusing on early stage structural pressure rather than headlines, you sidestep emotional entries, poor risk to reward setups, and exit liquidity problems. The goal is to be positioned before the narrative is obvious. The technical undercurrent, decoding the charts before the blast. The compression coil pattern. Many explosive short squeezes emerge from tight consolidation zones where price volatility contracts, daily ranges shrink, and short sellers grow confident that nothing is happening. This compression acts like a coiled spring. Once released, often on a catalyst, price expansion can be sudden and disorderly. Volume precedes price. In under the radar names, volume is often the first tell. Spikes on down days failing to push price lower, steady accumulation in thinly traded stocks, volume rising before any breakout attempt. When demand quietly overwhelms supply, price eventually has no choice but to follow. Short interest, cost to borrow, and liquidity stress. True short squeeze setups often show rising cost to borrow despite flat price, elevated days to cover in low float environments, and limited share availability during consolidation. This is where technical pressure and structural risk collide. Fundamental fuel. What actually ignites squeeze? Catalyst confluence. The most powerful squeezes aren't driven by hype alone. They're sparked by real, unexpected change, such as acquisition rumors or confirmed buyouts, regulatory approvals, product launches that invalidate the short thesis. When fundamentals shift suddenly, shorts must reassess under time pressure. Strategic partnerships. New partnerships can quietly transform a company's outlook. Access to distribution or capital, validation from a larger industry player, revenue acceleration that shorts didn't model. Often the market reacts before analysts update their assumptions. Debt restructuring and share buybacks. Shorts thrive on balance sheet weakness. When that weakness disappears, refinancing removes bankruptcy risk, buybacks reduce available float, and dilution fears evaporate. These moves force shorts into increasingly crowded exits. The under the radar advantage, data mining for diamonds, screening for obscurity. The best opportunities often live where market caps are small, coverage is minimal or non existent, and liquidity is thin but improving. Advanced filters help isolate names where structural imbalance can matter. Insider activity deep dive. Executives buying stock, especially in size, often precedes major moves. While insiders can't predict squeezes, they do know when pessimism is overdone. Clusters of insider buying in heavily shorted stocks are worth attention. Social sentiment anomaly detection. Instead of chasing viral trends, look for sudden increases in discussion from a low baseline, niche forums or discords before Twitter catches on, sentiment turning before price reacts. Early chatter is signal, viral chatter is usually noise. Your next play, turning the framework into action. Building your squeeze watch list. The objective isn't prediction, it's preparation. A disciplined watch list tracks structural short pressure, technical compression, and potential catalysts on the horizon. This allows you to act decisively when conditions align. Risk management is king. Short squeezes are asymmetric, but still dangerous. Smart positioning includes predefined stop levels, scaling rather than all in entries, and taking profits into strength instead of chasing highs. Survival comes before outsized gains. Case study, an overlooked squeeze from start to finish. A recent example illustrates how quiet accumulation preceded the move. Shorts underestimated a catalyst, volume expansion signaled the shift, and the squeeze unfolded rapidly once liquidity broke. The takeaway isn't the ticker, it's the repeatable process behind it. Final takeaway: short squeezes aren't luck, they're structural events that leave footprints long before price explodes. The traders who consistently catch them early aren't chasing hype, they're reading pressure, positioning, and imbalance before the crowd notices. If you know where to look, the market often tells you what's coming quietly.